I buy my property in my personal name, in the name of a company, or in a trust? Now, here's a trick question with maybe a trickier answer. If you're going to ask the average investor this question, right, they're going to say something like, my cousin says, or my cousin said, you must buy in your name. It's easier. Or my hairdresser said, buy in your own name. It's easier, right? Now, but the easier way is often the most expensive long term. And it also depends, if you're talking in terms of your property, is it a home that you're talking about, or is it your investment property? Because there's a massive, massive difference in the way that you buy your personal house, if it's the first time that you're going to buy a house, right? Or if you see this as an investment property, the way that you're going to do it. The way in which you're going to buy this property, irrespective if it's your home or if it's in an investment company, the way that you're going to buy it can save you millions of rands, or it can cost you millions in terms of tax, risk, and opportunity. So there are 7 laws of a property investor, and let's have a look at the 7th law that says plan and protect your assets through financial structures. Now, in the Wealth Creators University, we place a huge emphasis on protecting your assets. Let me tell you why. The Wealth Creators strategy says it's the intelligent use of limited resources to go from where you are to where you want to be in the shortest possible time with the least amount of risk. So the main thing when it comes to property will be the risk, because it's the risk that's going to kill you. It's a risk that's going to keep you from achieving your goal. It's a risk that's going to keep you from getting the right growth. But in South Africa, we're sitting with unique problems or situations because there's the Expropriation of Property Act, which means that if you do not plan and protect your assets, there's a huge risk that we are taking. And therefore, we have to make damn sure that we understand what we can do, how we can do it, and that we do it legally in the right way. Right. Now, a financial structure, a company, your personal name, or in a trust, these are ways that you can protect yourself. So if you own a property in your own name, in your personal name, you're going to be exposed to creditors. And I'm talking specifically in terms of investments properties. Therefore, you could also face higher taxes if this property starts making you money. In other words, if you're in a 45% tax bracket already, and now this property gives you more income, that income is going to be added to your current income, and therefore you're going to be taxed according to that. Now, you might lose your wealth in a lawsuit or in a divorce or in a business failure if it's in your personal name, because this is the way that the law is going to treat you. So if your goal is wealth creation and not just home ownership, you need a structure that's going to protect your assets. And when I say protect, I do mean protect in the broadest sense of the word possible. Right. So, first of all, legally, it must be able to reduce your tax liability or your estate duty liability or your capital gains liability. Right. So, we have to look at the full picture before we can make a decision. At the same time, you're going to use this as part of your legacy planning, of your freedom planning. And we have to make sure that it's going to fit in your financial freedom growth rate. In other words, if your financial freedom growth rate, whatever that may be, if the growth on this property, irrespective of what structure you're going to use, is not going to be higher than your financial freedom growth rate, you know that it's a bad property, irrespective. Right. Now, there are 3, let's call it common ownership options. And I'm very quickly, remember, this is not financial advice. This is simply the way that I see it. You have to get to the right people in order to give you the advice. But for an overview, there are 3 common ownership options. The first one is going to be your personal name. Now, normally, it's simple, it's easy. The bond approval is going to be a lot easier if it's going to be in your own name. But if there's a positive cash flow, it means that you can pay high tax. It can be very risky. And in your personal name, you've got no protection whatsoever. The second is a company or a Pty Limited. By using this as a structure, there's better tax planning, there's better estate planning. It can be scalable because now you start building property portfolios and therefore the one can offset the next one. But unfortunately, there's going to be more cost involved. There's going to be more admin involved. There's going to be more setup cost involved. You need an accountant or an auditor in order to be able to help you. The third way is through a trust. And just like a company, right, it's great for asset protection. It can be a legacy tool. It can be a financial freedom planning tool. But it's the most complex in terms of these three options that you've got. And of course, there's ongoing compliance. You have to take and get resolutions for each and every step that you take, each and every time that you buy a property, that you sell a property, that you change things. So it's a lot more complicated than just doing it in your personal name or your company. Or you can even set up a structure where the structure is the trust, and then there's a company, and then you buy the property within the company, and then the shareholder of the company is in a trust. But nowadays, especially with SARS, they are busy closing up all these loopholes that advisors would say to people that you can hide things in a trust and that SARS doesn't know about it. Now, I've said for the last, 23 years that I've been helping people, that's not the way to try to do it. The moment that you want to hide anything from SARS, you are setting yourself up for huge penalties. You know, these blind trust and complex trust is just a way to make bloody money, according to me. I may be totally wrong because I'm definitely not an expert and this is not financial advice that I'm telling you. But I'm sure that if you've got a trust, you would have seen over the last year or two, there's more and more, it becomes, SARS wants to know who are the beneficiaries. They want to know, even in a company, who are the shareholders, what's happening with that. And this is just to clamp down on those people that thought that they would get away. So right from the word go, from 23 years ago when I started doing and giving training on property, I would say to people, the last thing that you're going to play with will be SARS. So make sure that you keep it simple, that you keep it straightforward, that you know that you obey the law, and by simply doing that, you can do fancy legal tax planning and financial planning and estate planning and legacy planning. Don't listen to people that wants to make it complex. But now we've got all these structures. But do you know that this structure means absolutely nothing? Zult zero bugger all if you do not buy the right property. In other words, you have to do the sums before you sign the contract. And before you sign the contract, if the sums make sense that you should buy in entities, then you have to set up those entities, preferably before you actually buy that property, because the sum is going to tell you if it's a good or a bad investment. Right. What do I mean with the sum? There's only two sums that you need to do. Your FFGR, your financial freedom growth rate, and I'm quickly going to show you how easy it is to determine that. And then that's based on your surplus money that you've got, that you're going to use in this property as part of your investment strategy. And then we need to calculate what is your IGR. The IGR is the real growth that you're going to get on that property, on your surplus. Right. So let's take an example, and let's say it's 1.5 million. The bond over 20 years at 11.5% is going to be 14,500 Rand per month. Right. Now, we assume that you are going to get a rent of 12,500, which is a little bit better than the average for a property like this. So 12,500 Rand per month. We start adding up all the expenses, the rates in taxes, all the levies that you have to pay, the insurance, if there's any insurance. Well, there will be insurance based on that if you are going to apply for a bond. And let's assume that is 3,000 Rand. So now we're going to look at your cash flow. So from a cash flow point of view, 12,500 Rand coming in. but it costs you 14,500 to service your bond, of which the biggest portion will be an interest that in the event that you can deduct that interest portion, especially in the first couple of years, plus for levies and costs like that, 3,000 Rand. So your negative cash flow runs to 5,000 Rand per month on this property, right? That simply means that in the event of this property, there's a 60,000 Rand that you are bleeding out per year. In other words, you have to find that money somewhere. Now, we are going to sit here with a trick, right? Because how do we know if this money is going to work hard enough so that it becomes an investment? Because it's no good to say, I've got 5,000. You can use that 5,000 to invest in anything. We have to look and see, but what is your financial freedom growth rate? Your financial freedom growth rate, a quick way to do it, is, for example, to say, what do I need in 10 years' time additional? Let's assume it's 10 million, just to make it fun. We call that your freedom number. This is what you have to aim for and what you have to get in order to be financially free. Right. Remember, you've got 5,000 Rand per month and you've got 10 years in terms of your planning. Now we sit down, go to Excel, do a little calculation, and you're going to see that if your money can grow at 43.83%, let's make it 44%. If your money can work at 44% anywhere, but specifically in this specific property, you know, okay, I can go for that. If not, there's no ways that you're going to do it, right? Now, on this specific property, I can tell you that you do not need to know anything. There's no tax planning. There's no decision if it's better in your name, in a company, in a trust, from a tax planning point of view. Why not? Because it's a bloody bad property. It bleeds 60,000 Rand. So the only way that you'll ever be able to make it up is if there's enormous capital growth. So on this property, you're going to maybe sit with between 8 to a 12% IGR. In other words, over a 10-year period, if you take everything into consideration, that's going to be the situation. Therefore, your IGR over a 10-year is smaller than your FFGR based on the 5,000 Rand that you want to invest if you could get that at 100% bond. Right. So suddenly you can see it becomes irrelevant from a tax point of view from if you buy this property in your own name, if you do it in a company, or if you do it in a... Because SARS is going to simply say, for the first 5 years, if there's not a positive cash flow in your personal name, and you've bought it in a personal name, they're going to ring-fence that. So no tax benefits whatsoever. There may be a capital gains tax when you sell the property and you've bought it in your personal name. This is normally happens on your residence, private residence. But if the intent was for an investment, there is immediately capital gains tax on that. So, and that's why right in the beginning I've said, is it your personal house, your residence that we are talking about, or is it your investment? So if it's from an investment point of view, you're not going to get that tax, let's call it a tax break in terms of the 2 million capital gains tax, right? So the only time that tax is going to play a role will be if that property is in a positive cash flow. Now, there are different ways that we can get into it if you do not know what you're doing. For example, if you're going to put down a full deposit that there's no bond, then immediately you're going to have to pay income tax, right? Can you see? In other words, now that structure, the financial structure, is not only the entity structure, it's also the financial structure that you need to have a look at. Because otherwise, guess what? This property is not going to help you to get to your goal, which I believe is to be financially free or to get an income. But in the growth phase, you do not want to pay any taxes because it's going to influence your IGR on that property. So if you've bought the right property, now it's a different story. Because now we have to look at what are the tax situations. Now, in the Property Pro investment system, it's actually a very, very easy calculation to do. You go, when you get into the tax, you simply say, okay, option 1 is I'm going to do it in a trust. Option 2, I'm going to do it personal name. Option 3, in a company. Once you've got that, you're going to see a clear winner emerging on that specific property. Now you can say, okay, but because I know a little bit more about financial planning in tax structures and financial structures, what if I combine that, for example, in a trust for estate duty purposes. But now you have to look at Section 33D of the Estate Duty Act and make sure that you do not control the trust directly. Okay, so for that reason you need a little bit more planning, and you need to see the right people. I'm not here to tell you what to do. I'm here to tell you what is the outcome of the different options that you have and what you have to look for in order to make sure that you're going to get the maximum from that, and to make a decision if you should buy in your personal name, your company, or in a trust, or at least start the investigation in that. So the moment that there's a positive cash flow, and remember, to get a positive cash flow is not too difficult. For example, if I use that and I do not structure a credit loan account and I use that as a deposit, SARS is going to see all the income as income. And there's no interest portion like in a bond that you can deduct. So if you bought in your personal name, you're going to pay up to 45% income tax. That is, of course, if you are already at the 45%. So it can start very low, and then 18% basically is the minimum, and then with the sliding scale it goes up to 45%. Capital gains tax, it's 18%, but if it's your personal house, your residence that you stay in, right, the first 2 million, there's a rebate or an exemption that you're going to get on that. Now, imagine that you buy the same property, but it's structured in a trust. In a trust, it's also 45% tax that when you sell, and that capital gains stay within the trust, 45% on that. And a lot of people will say that is why it's bad. But there's a Section 25B of the Income Tax Act that simply says that if you conduit that legally, now there are things, and that's why you need to go to experts to help you with this, right? You can conduit that to the beneficiaries, and they are then going to pay that tax in their personal name, the capital gains tax. And the SARS distinguish between income tax and capital gains tax. So it's two different calculations that they do. And for that reason, make sure that you understand. Now, I've got a course on trust for the entrepreneur and the investor, where I'm getting really deep with the property advance course, where we look into the structures and how to do these things that can benefit you a lot. And there are a lot of attorneys and a lot of chartered accountants have done, and the feedback that I'm getting is one of the best courses they've ever attended in their lives. Right, but you have to make sure. So you can't even rely on that person, because if that person does not know what to do, you're going to pay the penalty for that. For that reason, you need to have that information before you tell them to put your structures and your deals together. That means you have to take the responsibility if you're serious. If you're not serious, you're going massive balls up of this whole thing. I can tell you that. Why do I know this? Because for the last 23 years, I had hundreds, well, let's call it thousands of different experiences where I could see what students were doing and the outcome. And that is, I've built up an enormous database, and because of that knowledge base, so to speak, I can tell you categorically that 98% of South Africans do not have and do not know how to do structure planning, right? And they've never incorporated that in the right way to get the best benefit and the best protection on that, right? So capital gains tax can be reduced or neutralized if you pay it to the beneficiaries, as I've said, in a trust. So if you add that to their income tax, they're going to then pay according to their marginal rate, whatever that marginal rate is going to be. There's a whole calculation that they are doing that. So they break it down depending on your rate, but effectively it can be as low, or in a personal name it's 18% in any case. So we have to then look at asset protected in a trust, and that is where there's incredible advantages. But there are conditions in terms of your personal liabilities, right? If it's protected and you've done it correct and there are no credit loan accounts, then in a trust, those assets can be protected. Plus, if you take it to the next level in terms of appreciation, that can be protected. We call it estate planning or estate pegging, right? So you can peg your estate, and all of this is legal. As I've said again, make sure that you get the right expert advice on this. I'm not here to tell you what to do. I'm here to give you an indication of what to do and how to do the calculations, basically. Right. So make sure that you do not stand security, but you're going to find that in the beginning, the banks are going to come back to you and say, okay, but you have to, in your personal name, or the trustees, or someone has to stand security when you're going to buy these houses in your personal name, or in a trust, or in a company, or stuff like that. Right. So the right structure, if we do it the right way, is going to increase, or can increase, your investment growth rate over 5, 10, and 20 years. Right, and therefore means that you're going to get a better deal. Your IGR is going to be bigger. But remember, the criteria here is that your IGR, your investment growth rate, must be bigger than your FFGR. And this is why it is crucial that you invest first of all into yourself. Now, remember, there are 7 laws of a property investor that is at work here. The first law is you must invest in learning how to structure work. If you're not going to do that, my friend, I can tell you that what they're going to tell you is that you can go and get all these deductions and then only to find out that it's not, and that means that you're not going to optimize your IGR. The fifth law says don't just do what is easy, do the sums. And unless you can do the sums to see, depending on the structure that you're going to use, your IGR is bigger than your FFGR, walk away. The 7th law simply says protect your assets or risk losing them all. If you are not prepared to do this and understand how to do this, or get professional advice in order to help you to do it, you're going to run into a problem. But then there's legal considerations that we have to take into consideration. For example, we have to look at the Income Tax Act, Section 25B and 7, for example. This is going to govern income splitting in trust. And by the way, nowadays it becomes a lot easier now that I say 25B and 7. Just go and Google that. You don't have to go and then make sure that you understand what it means, because you can then plan according to that. But do you know there's also the Trust Property Control Act, that is 57 of 1988. And this regulates how trustees must manage the assets of the trust, right? And therefore, you have to make sure that you understand it. And this is why we've got that Trust for the Entrepreneur and Investor, basically a course on companies and trust and how to use it and how to optimize that from estate planning point of view, or from a legacy planning, or from a financial freedom planning point of view. Right. The Companies Act, that is extremely complicated, right? Now, that impacts the compliance and the governance of using a company. Now, it sounds complicated, and it is complicated. But do you know, when it comes to property, there's only a few laws that comes into play, or a few of these sections of the Act that's really applicable, just like the income tax. The income tax is extremely complicated. But when you apply to property and you know what to look for, you're going to find it's not complicated at all. Once you understand, and this is what we do in the mentoring, we take you through the process, we show you how simple it is, what you have to look for, what you need to get in place, and how you can benefit maximum from the different sections within the Act, in terms of, let's call it the company or the trust, or in terms of the Income Tax Act, how it can benefit you. Now, that legal structure isn't just, therefore, a accounting decision. It's a strategic decision. And this is why it's embedded, it's built in, it's baked into the Property Pro investment system. Because the moment that you go through that, you understand these different options, you're going to see immediately anywhere actually in the world, not only the tax structure in South Africa or the different options that we've got, but anywhere in the world, right? So if I could give you, like, let's say we can give you a summary, or the final word on this is that if you're serious about building a property portfolio, in other words, you want to use this thing for financial gains and for legacy planning and for freedom planning, then it's not just about, do I need to buy this property in my own name, in a company, or in a trust, right? It's not just about buying properties anymore. You must learn how to structure the right deals in the right way, right before you actually sign that contract. Right. Why do I say this? Because the way that I see it is that the structure, the financial structure, the entity structure that you're going to buy this, forms the skeleton of your wealth creation process. Right. So it's not a once-off. And this bullshit story that people have, that you need to have each and every property in a different a company and a different trust is just maybe another way for other people to start making money out of you. You can set up very fine structures, very secure, without trying to make it complicated. And therefore, make sure that you understand how it works. And again, we've got the trust for the entrepreneur and investor that you can have a look at that. In other words, if you get this structure right from the word go, and you know exactly where you want to go, right? You start by building it right from the word go, right? If you do not do that, my friend, it's going to break when it grows. And I've seen this over 23 years, time and again, where these structures break the moment that people reach the next level. So put in the time and the effort before you actually start with this process. Now, there's a lot that I've said. What now? Maybe I can help, or my Wealth Creators University or method can help you. So, and the way that we normally do it is if you want a personalized property roadmap built just for you, then I know for a fact that we can help with all the experience that we've got. You see, what I've seen over the last 23 years in helping people. Now, remember, I'm 40 years that I've been a property investor myself. I retired at the age of 37 because of property. But my main experience started by, I started teaching, because then I could look at what all these planners, how they plan these portfolios. And based on that, I could see what is working and what is not working, right? So on that, I can tell you that 99.9% of property investors that fail does not fail and do not fail because of the economy. They fail because they make one bad decision. So when I start analyzing people and I see where they are and where they could have been, I can almost always track this back to one of two mistakes that they've made. One, either in buying their first property, or secondly, when they start a business and they started that business in the wrong way. Now, today we're not talking about business, we're talking about property. So when the property is not giving them that they need, I can tell you categorically that it was because they've made the mistake right in the first deal that they've made. And that deal is costing them years and years of progress and millions of rands. Now, people say, okay, but it can't cost me millions of rands. But there's an opportunity cost. Remember in this case that we've talked here, there's 5,000 rand, right? That 5,000 is the money that you've got a surplus, and that 5,000 must secure your financial freedom in 10 years or 20 years or 40 years. Now, if you misuse the 5,000 rand and you do not get that growth, you cannot accelerate the process. You cannot take that as the baseline and then start building, right? In my Property Accelerator Masterclass, I'm going to show you actually how it works. So if you mess that up in the beginning, you take yourself out. And now the lost opportunity cost of money comes in, because if you could get a 45% growth or a 60%, especially in the beginning, right, it's going to change everything for you. But because people do not understand and get that right in the beginning, it keeps them in this cabal system, in this global elite system that wants you to work for the rest of your life without you getting out of that system. And this is why I started the Wealth Creators University, like the Wealth Creator Strategy, like 23 years ago. Because Tanya, my wife, said to me, go and teach people what we have done, how we got out of the system, so that they do not make the same mistakes. Now, I can't tell you what to do and what not to do, but I can tell you what I've done, what we are still doing, what my students are doing, and then they can tell you what the results were from doing this that we are teaching. Because what we teach has got nothing to do with the financial system and the way that they want to do things, because their job is to keep you poor. So we do not want you to be in this trap for the rest of your life. And that is why, if you are serious about your property and your investments in general, then we'd love to build you a custom roadmap. And that is based on your current level, because let's face it, every single household that I've met over the last 23 years is in a different place in terms of your resources, in terms of your skills, in terms of your financial freedom goals that you've got. That's if you've got. Most people haven't got. But if you do have, it's different for all of us. And we call this your personalized wealth roadmap. So if you are serious about that and you think that we can help you with that, because of all this experience with working with thousands of different, let's call it indirectly, financial planning and estate planning and tax planning experts, because I could see in the results of my students what was happening, I can almost say with 99% certainty that this plan that will help you to put together is going to be the fastest, the smartest, the safest path with the least amount of risk, where you can go from where you are right now to financial freedom, if that is something that you would be interested in. In other words, my case when I started in 1987 was to be financially free. And financial freedom to me means different than to you. So in my case, financial freedom meant to be able to do what I want, when I want, how I want, where I want, with whom I want, without worrying about money, so that I could pursue the things that I was interested in. For example, one of the things that my passion today is to teach. And I think that you can see from what I'm giving you in this free educational session that I'm really passionate about helping other people not to make the mistakes that we have made, that we had to pay for. And therefore, I can pay it forward by helping you to give you a structure or a plan or an idea, a strategy to use property as an investment. Because to me, for the working class that's getting a salary that starts off, there is no better investment than property, right? This is the way that I see it. So in short, this powerful Property Pro assessment will help you to identify the biggest opportunities with the least amount of risk. In other words, there are always risks, as you've seen. And protection is one of those risks that we talk about in terms of the different structures. We're going to show you where you are, at what level you are, and then for that level that you're at, because the quickest way to become successful is to get the right information, the right order for the level of the game that you're at. And then you have to apply it to measure the result, because from the moment that we've got the results, we can manage this whole process. So we're going to show you what skills or strategies you need next, or that you need to work right now on in order to take you to the next level. And therefore, we're going to help you to understand what your current situation is, where you are, and we're going to show you how we can support you personally in order to go from where you are to where you want to be. Of course, you still have to do the work. You still have to take the responsibility. You still have to gain the skills, right? Now, if you qualify for our mentorship program, we're going to show you exactly how it works. We will come back to you, we'll show you, we will give you the plan and tell you step 1, step 2, step 3. We call it the Wealth Creators Method. This is the method that you have to apply. This is a step-by-step blueprint, in short. Right. Now, what if you do not qualify? Right. No problem. We're still going to give you the feedback as well as the steps that you need to take. There's no pressure. And I hope that you see by now that my job is to add value, immense amounts of value. But that value means absolutely nothing unless you're going to apply it. Right. So we're going to give it to you. And then wait for you to start taking the actions so that when you are ready, we can start talking in terms of the mentoring program as such. Right. Now, what do you need to do in order to get your own personal roadmap? It's very, very simple. In the comment section, put in the word roadmap. Make it one word, roadmap. Or, make it one word, roadmap. Right. And then we're going to send you the assessment form. It's a 3-minute tops. You're going to fill it in. You're going to send it back to us, and then we're going to help you to map out your future. In other words, the path that you need to take. And we're going to do it together in order to save you time, effort, money, and perhaps a ton of blood, sweat, and tears in the process. There's another way that you can get benefits, and that is simply join our free Property Accelerator Masterclass. And this is where we're going to take you and show you the 3 secrets. Do you know that there's just one reason why everyone that is not successful, why they're not successful? But I'm also going to give you a strategy to show you how simple it is not to fall into that trap and stay within this rat race. Right. Then I'm going to show you another secret where you do not need any qualification, but at the same time you can get the same outcomes that we and our students are getting. And then I'm going to show you what these different levels are and what you need to do in order to move through these levels so that you can get to your end result and end goal as quickly as possible. And in the process, I'm even going to help you by giving you 2 free tools or PDFs that you can use. The first one is the 7 Laws of a Property Investor. I've talked about that. You will get that free if you stay to the end. And then also I'm going to show you how to set up power goals, because most people do not know the difference between a SMART goal that does not work and will never work because it's mediocre goals, and what we call power goals, and what are the steps. And I'm going to guide you through that in order to set up your power goals so that you can be financially free, let's say, within the next 5 to 10 years, even if you do not think at this stage that you do have a surplus, right? But it's up to you, and therefore I'm going to throw the ball back to you. 2 options. 1, put in a roadmap, and if you qualify, we'll come back to you. If you do not qualify, we'll also come back to you, right, with a plan. And then secondly, you can say, okay, I'm a little bit skeptical. It's a 2-hour session. Join the Property Accelerator Masterclass. In the description area, you're going to find the information, and then simply fill that form in, book your seat, and then go for it. All right? Make sure that you pitch up because it's really valuable. Now, if you found value in today, in this training session that I gave you with this, starting with this question, how should you buy the property in your personal name, your company, or in a trust, or in a combination of that, then what about giving me a like? Now, if you hate this content, well, I don't think you would be here if you hate it, but give me a thumbs down. But do me a favor, please. Tell me, what is it that you don't like? Don't you like it that I'm truthful and that I'm open and that I play open cards with you? Or what is it? Because I am in the process for the last 42 years in my life where I want to improve. In other words, I'm a lifelong student. And the only way that I can learn is if you tell me, honest, but I don't like this, or you are doing this, or this that you say is wrong. This is how I'm learning. And I'm learning from anyone. So give me that thumbs down if you want. But tell me why. Because in that is my learning experience. And I am desperate to learn in order to become a little bit better, or at least not to make that mistake over and over again in my life. Right? Otherwise, what about the thumbs up? Or what about if you really got a lot of value? Because I'm doing a lot of these questions where I'm trying to help people from all over the world. What about you share this with someone that you know should have this information and must perhaps pay a little bit more attention, or that you know can benefit from this? Then I will really, really appreciate if you pass this on and share this with other people. Right. Also, if you've got a question in the comment section, maybe post that question. It's not 100% to say that I'm going to do it, but if I get the same kind of questions like this one that I'm getting on a regular basis, I'm going to make a training session just on that. And it's not to give you any advice that I can't do, but I can tell you where to start the process and what to look for and what not to look for, like I've done in this training session. So thanks once again for the time and the effort that you are putting in becoming the best version of yourself. In other words, the personal development, Warren Buffett says, is the best investment that you can ever make in your life. And I agree 100% with him. There is no better investment than this. And I hope that this video and this training session was proof that that is the case. Because if you just do what I've told you to do and dig deep into this, you're going to see that you're going to save yourself millions and have a great and a wonderful and a fabulous future. If not, my friend, we call it tough luck, you are going to suffer. Right? So take the responsibility and pay a little bit of attention to this. Thanks for your time. See you in the next one.